Hi there, welcome to Kneppy Invest. We're finally there. We're finally at the final video in this series, looking at the best performed companies on the ASX since 2013. The first part of this series, we're looking at companies with a market cap above $1 billion as of the end of May 2023. And in this part of the series, we have had a look at those 30 companies that had a market cap below $1 billion. And the main reason I wanted to do this particular project is I just wanted to see the characteristics of the best performing companies. Now, I had an idea what I would discover, and those ideas did really play out. We're talking about return on equity, earnings per share growth, revenue per share growth. All those sort of things are characteristics of the best performed companies since 2013. Now, a few surprises in this top 5 list, and a few companies I knew would be there. In fact, the company that came in at number 5, I think if I extended this to 2024, this company would be number 1, and that would become quite apparent when we get to that particular company. So a few things I should get through before we have a look at this top 5 list. Now, I did have a few filters when I did initially drop this list about a year ago from when I'm recording this video. So I started this project just after May 31st, 2023. So we're almost at the 1-year anniversary. So the first filter for this particular video series was looking at companies with a market cap below $1 billion. Already a series with looking at companies with a market cap above $1 million. So that's a very first important filter. The second and third important filters were just, I want to exclude companies that had a story. They had no revenue, they just had a story. And the reason I wanted to exclude those sort of companies is because you can't decipher any sort of characteristics from these sort of companies. They have no revenue growth, they have no return on equity, they have no earnings per share growth or margins because they're not selling anything. So I excluded all story stocks. So these companies had to be making a revenue. Preferably, I'd like all these companies to also be profitable. The next filter I did was I wanted to eliminate all mining companies. Mining companies are quite cyclical, and a lot of companies that would have made it onto the list are mining companies that are not yet in production. So that's another reason why I wanted to exclude mining companies. So all these companies in this particular series and also the previous series are not mining companies. And very important point here, this is based off total returns. Now, this is not quite as important in this series compared to the previous one, looking at companies with a market cap above $1 billion, because total returns is capital gains, so share price appreciation plus dividends. Should always include dividends when you look at your total returns. Before we get to the list of 5 companies, a very important point here, just because these companies have performed really well over the past 10 years, or that period of 10 years between 2013 and 2023, is not necessarily a predictor that these companies will be successful in the future. The main thing is I just wanted to find the characteristics of all these companies. And if there's similar characteristics, then maybe that is the universe telling us this is what we should be looking for when we're researching a company. Coming in at number 5 is not a surprise. And this is the company I think would probably come in at number 1 if I extended the end period by 1 year to May 31st, 2024, which is only 2 weeks away from when I'm recording this video. And that is Supply Network. Now, this company provides aftermarket parts to the commercial vehicle industry in Australia and New Zealand under the Multi-Spares brand. And this company has absolutely wowed the market over the past 10 years. You'll be able to see that just by looking at the chart. And I've never been a shareholder of this company, even though I've been following the fortunes of Supply Network for over 5 years now. And I am kicking myself that I've never taken that chance on this company because the chart looks amazing. And all these metrics look absolutely amazing as well. Revenue per share growth, 14% per year. Earnings per share growth, 16.4%, which means because earnings per share is growing at a quicker rate than revenue per share, that means the company's margins are growing as well. dividend growth at 19.6% per year, and gross margins at 42.1% and rising, return on equity at 30.6. Now that is a 5-year average. I should make that quite clear. That's a 5-year average. And I think this is one of the best determinants of the potential future success of a company. Return on equity, return on invested capital, return on capital employed, or return on capital. And I'm just using return on equity just for, I suppose, just to be consistent through all these companies. But if you used return on invested capital, you'll probably see a pretty big number there as well. But 30.6 is a really good number, and the sort of number I am looking for long-term investments. In fact, I'm looking for any company with return on equity above 10. I would take a return on equity of 12 for any company I want to put into my long-term portfolio. And the analyzed total return, fairly similar to the return on equity at 31.48% per year. Now, the market cap of this company was only $49 million in 2013. It has grown to $580 million. So this has been a 10-bagger in terms of market cap for shareholders, but maybe not in terms of share price, because shares on issue have slightly increased from 34 million to 42 million. But definitely, this is one of the highest quality companies on the ASX with a market cap below $1 billion. And as we take a look at Supply Network's chart, this is the weekly chart over the past 10 years. This is the sort of chart you want to see for a high quality company. And the share price of Supply Network has actually increased another 33% since May 31st, 2013. Back in May 2013, share price of this company was roughly between $2.50 and $3. Now it's around about $21. So not quite a 10-bagger over a 10-year period, but if you were a shareholder of this company during this 10-year period, you would not in no way be dissatisfied with Supply Network's performance. And probably, I'm going to have to admit right now, this is the best looking chart out of all the companies in this series. Coming in at number 4, we have a company called Advanced Zintech. Hands up, who's never heard of this company? I'll put my hands down because I actually have heard of this company, and I was a shareholder of this company back in 2015 or so. And then I got out, made a very small profit. I thought I was a genius. And then the share price went on a massive run. You'll be able to see that when we look at the chart. Now onto, and if, just like Supply Network, if we extended this exercise or this project to May 2024, I think Advanced Zintech, instead of coming number 4, might have had trouble getting into the top 25. That should tell you how much this company has struggled in terms of the share price in the past year. Now on to the, before that, what does this company do? They're the manufacturer of aluminium oxide powder, zinc oxide dispersions, and zinc oxide powder for personal care sector. For example, they do sunscreen, zinc sunscreen, that sort of thing. Anyway, so let's have a look at the financial metrics of this company over the past 10 years. So revenue per share growth, 15.2% per year. That's pretty nice. Earnings per share growth, 6.3. Now that is a little bit concerning that earnings per share growth is growing not quite as strong as revenue. Dividend growth is not applicable here because they have had no dividend 10 years ago. Gross margin, pretty nice at 59.9%. Return equity, pretty nice again at 20.5, but I think that is struggling. And again, that is a 5-year average. And I didn't have a look at the last year, but I would assume right now the return equity for this company over the past few years is quite low, if not negative or not applicable, because they might not be earning, may not be producing any earnings in the past year or so. And the analyzed total return, 32.47%. Now, the market cap of this company has gone from $7 million to $122 million. So that has increased by about 15, by a factor of 15. And the shares on issue have increased from 59 million to 62 million. But let's have a look at the chart for this company, and you can see how different this particular chart is to Supply Network. Now, I would consider Supply Network to be a quasi high quality company. I definitely can't say this company is high quality, and you can just see the difference in the chart. So let's do that right now. In fact, this chart reminds me of a company that's gone through sort of like a hype or fear of missing out period where the market just loves the company for a short period of time. And that period of time was 2019. not during COVID-19 or after COVID-19. It was 2019 when the share price of this company went from about $1 all the way to a high of almost $8 in 6 months, the first half of 2019. Now, in 2018, even the last half of 2017, that's when we saw the share price of this company starting to run up. But we saw that increase in volume and the increase in share price in 2019. Now, the share price of this company has pulled back a long way. In fact, it's gone from a high of nearly $8 in the middle of 2019 all the way back down to below $1. And the share price just keeps on falling. But if we compare from May 2013 to May 2023, the share price of this company has gone from a few cents back then. I'm pretty sure this company did a share consolidation because I remember seeing this company about 2 cents or even below 2 cents. And then I think the share price went to 20 cents. So maybe a 10-to-1 share consolidation. So we just say 20 cents back in May 2023 to 2013. And in May 2023, the share price of this company was about $2. So almost a 10-bagger over that 10-year period. But hopefully you got, if you were a share of this company, you got out well before May 2023. Coming in at number 3 was not a big shock, and that is Australian Ethical Funds. If you don't know what this company does, it's in their name. It's a fund manager that specializes in environmental and socially responsible investments. Now, I think they just put the name ethical in there to draw in people willing to invest in this fund. Now, I might be a little bit cynical because if I had a look at some of this company's investments, I could probably poke holes in their ESG filters. But anyway, that's who they are. And they have been popular over the past 10 years because they've come in number 3 in this particular list. So let's have a look at some of the financial metrics around this company or this fund manager. Revenue per share growth, 17.6%. Earnings per share growth, 19.9%. Dividend growth, 20.4%. So nothing absolutely to complain about this company just yet. Gross margin, 67.7%. Return equity, 41.3%. And the analyzed total return, 32.51. So again, nothing to complain about looking at these financial metrics. Another company with a really high return on equity, similar theme for most of these companies, and a really nice analyzed total return. So again, nothing to complain about. Markup of this fund has gone from 22 million back in 2013 up to 307 million in May 2023. And I think the markup and the share price right now is higher than it was 1 year ago. So this company might have come in number 2 behind Supply Network if I extended this project by 1 year. Shares in issue haven't increased all that much from 102 to 112 million. As we take a look, Australian Ethical Investment weekly chart, it's actually quite hard to see where the share price or what the share price was back in May 2013, roughly about 75 cents. And if you're a shareholder of this company at that point in time, and you didn't see any reason to sell out until maybe late 2022, and then you thought maybe if the share price gets to $15, I'll take my profits, you perfectly timed it because the share price of this company went from 75 cents to about $15, just above $15 at its peak, which means this was a 20-bagger from May 2013 to the share price peak. But once interest rates started to rise in late 2021 into 2022, the share price of this company did suffer. Share price went from $15 and pulled all the way back to $2.50. And one of the main reasons behind that, if you did have a look at the P/E ratio of this company, when it reached a high of $15, it was absolutely ridiculous. This was just fear of missing out, too much hype in this particular fund back then. And even when the share price fell to $2.50, there was probably not much of an argument. This company was cheap. But the share price has recovered over the past year. And I should actually also mention, the share price low was around about the end of May, start of June 2023. So even though this particular project end date was May 31st, 2023, which is around the bottom in the share price, this company still came in number 3. And again, yeah, the share price has recovered since then. And that's why I'm thinking if I extended this particular project by 1 year, this company would have come in maybe 1 or more likely number 2. And if I ended this project at the end of May, or even at the end of 2021, this company probably would have come in at number 1. Coming in at number 2 is not a surprise. I fully expected this company to be high on the list because I do know the history of Energy One. Energy One provides software and services to energy companies and utilities. They specialize in wholesale energy, environmental, and carbon trading markets. They deliver solutions designed to streamline and enhance operational efficiencies. I have been a shareholder of this company in the past. No longer M1 now, which might be a mistake because I do think there is potential for this company to grow quite significantly in the next 10 years, just like they have in the previous 10 years. So let's have a look at how this company has performed financially over the past 10 years. So revenue per share growth, 38.4%. Earnings per share, 23.2%. Dividend growth is not applicable here because they didn't have any dividends 10 years ago. I'm not even sure they have dividends now, maybe a token dividend, but that's not the reason to invest in this type of company. Gross margins 39.2. It's one thing I'd like to see increase for this company. I'd like to see the gross margins increase. Return on equity, average of the last 5 years, 12.4. So that is one slight difference of this company to many of the other companies in this particular list, a lower return on equity. And that is a little bit concerning in my opinion, but the analyzed total return, 47.6% per year. You would not be complaining at all if that is, if you get that sort of return for any sort of investment. But to get that return in this company, you would have had to bought this company when it had a market cap of about $1 million. And I can almost guarantee you not many people had heard of this company. In fact, I'd say the vast majority of ASX investors did not hear of this company back in 2013. And I can even say now, a lot of investors have not heard of this company, even though the market cap of this company has increased from 1.2 million to 86 million at the end of May 2023. Shares on issue have increased a fair bit, 18 million to 30 million. Company has made a few acquisitions, but even with that increase in shares in issue, still phenomenal returns for shareholders of the past 10 years. So let's have a look at Energy One's weekly chart, and fairly similar chart to some of the other companies in this list, where the share price high was late 2021, early 2022, and the company has gone under a little bit of stress, or the share price has been under a little bit of stress over the past 2 years. The only company that doesn't have a similar chart to this is Supply Network, and that is an absolutely beautiful chart. But Energy One share price back in 2013 was low. It was like 10 cents or something ridiculous like that. So the share price went from 10 cents when it had a market cap of about $1 million all the way to a high of just over $7.50 at the start of 2022. Share price did more than halve, went from $7.50 down to below $3. There was a takeover bid for this company, if I remember correctly, and that takeover bid failed. That's why the share price popped up towards, I think it was August, September 2023, and then the share price dipped back because that takeover bid failed, and the share price has been going sideways for the last 2 or 3 months. So I definitely think this company has more room to move from here if they can continue to grow like they have been growing, if they can increase their gross margins, increase their return on equity. I think definitely this is a company to be watching over the next 10 years. And finally, we get to number 1. And to be honest with you, this was a little bit of a surprise. A company I have heard of, but I have never taken a hard look at. I've really just discarded this company every single time I've seen it. And that's probably to my own detriment because this company has performed absolutely spectacularly over the past 10 years. Now, one of the reasons I haven't really had a look at this company in depth is because of what they do. They specialize in ICT contracting, consulting, and recruitment. They provide staffing solutions in the areas of ICT, finance, administration, human resources, sales, and marketing. So just when I read what they do, I just don't get excited. But what I do get excited is just these growth numbers. Revenue per share growth, 26.8%. Earnings per share growth, 48.3%. Dividend growth, 34.9%. Gross margins of 19, which is understandable for a company like this. I wouldn't expect high gross margins. Return on equity, 56.3. That's a phenomenal return on equity. Not only that, the analyzed total return for this company over that 10-year period was 50%, or just over 50%. the only company in this list that are analyzed total return of above 50%. So again, another company with a really high return on equity. And that is, again, a 5-year average. So it's no surprise that this company's market has grown from 1.6 million. Yes, you could have bought this company almost outright in 2013. And maybe not outright. You could have actually asked your friends to give you some money, and you could have bought this company outright for $1.6 million in 2013 and seen the market cap of the company grow to $76 million in 2023. Still seems fairly low, but that's what happens when you have a market cap around about 1.6 million. Now, the reason this company came in ahead of Energy One, even though Energy One's market cap has grown more than Hightech Group, is shares on issue. So Energy One's shares on issue have not quite doubled, but I think they've grown by about 67%, while Hightech's group's shares on issue have only increased by 11 million, from 31 million to 42 million. And dilution is important when you look at analyzed total returns for a company you own. You don't want to own a company that is very happy to dilute their shareholders. Now let's have a look at Hightech Group's weekly chart. And even though this is not quite as impressive as Supply Network, definitely better than the other three companies in the top 5, because we haven't seen any massive dip in the last few years, unlike those other three companies, but not quite as good as Supply Network, because Supply Network's chart just keeps on going up. Hightech Group's chart, you can see share price has really struggled over the past 3 years. And when I say struggled, I mean just going sideways. Now, there was definitely a breakout in Hightech Group's share price back in 2015. In fact, 2013, 2014, share price of this company did nothing. So I'm going to assume this company did nothing back then, but something happened to get the market excited in 2015. You can see a massive increase in volume, and the share price absolutely took off. That would have been the time to get excited about this company, because even if you got at the peak there in 2015, you could have bought at 50 cents and felt dreadful for about, say, a year because the share price dipped. You'd still be very happy because you could have bought it in 50 cents and seen the share price go up to a high of $2.40. So this could have been a fire-bagger, even though share price has gone sideways the last 3 years, even though you could have bought at the top. But a nice looking chart, nothing to complain about right here, apart from maybe share price really doing nothing in the past few years. But otherwise, beautiful looking chart. And that is all I have for this series. Finally, looking at the best performed companies on the ASX between the period of May 31st, 2013 and May 31st, 2023. The main reason I did this particular project was just to look at what sort of characteristics will be similar among these group of companies. It's quite obvious. Return equity is important. Revenue per share growth is important. Earnings per share growth is important. Margins, not so important, but still you would like higher margins. But I think those are some of the things to look for when you are researching buying companies for the long term. Otherwise, I'm very glad that this project is finally over. Now I can go to other projects that I'm working on. And probably last thing I should mention is I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.